Hey guys, Akil here. Welcome back to another episode of the Trading Coach Podcast, another video edition for you. So if you want to see kind of the fun and cool version of the podcast, make sure you head over to Spotify or make sure you head over to YouTube to watch. You're fine listening wherever you are listening at. But with the video version, I tend to do kind of fun things to make fun edits. So people have said it is worth the watch. So I am relaying that message to you. Today, I want to talk about having a better understanding for your trading. And this thought, like many thoughts for the Trading Coach podcast, came to me randomly, right? I was just out shoveling the track, right? So what that means is this. We've been dealing with probably one of the coldest winters I've ever experienced. We'd had a bunch of snow. I coach athletics or track and field. And well, I've always lived kind of by the understanding that you don't wait for people to do stuff for you. If you want it done, do it yourself. So I was out there for the last couple of days with the shovel, shoveling the track, all 400 meters of it. So that was at least the intention. And I kind of like it in a weird way. It counts as my physical activity for the day. But that time by myself in space, away from people, away from charts, away from emails, is kind of like my self-reflection time. I've mentioned this in previous podcasts where I like going for runs and doing workouts because it allows me to kind of mentally reset, reflect on life, and it allows the brain to kind of turn off all of the other actions and things that it's thinking about and just kind of be curious and be creative. And that's when our best ideas come. Think about any time you've been on a long trip or like an airplane flight and you come up with brilliant ideas. It's because you literally can't really be doing anything else. And I had an idea kind of stemming off a conversation we had in my live trading room the other day. So recently we've been talking a lot about human behavior, crowd psychology, and how that affects the market. And my theory on that is this. It may not be it for you, but at least for me personally, I feel as if when I had a better understanding of why the markets moved, it allowed me to be better at predicting how the market moves, meaning that when I understood human behavior patterns, when I understood crowd psychology habits and understood what the movement on the price chart actually represented with us and all of the market's participants, it allowed me to see the market in a different perspective and it helped me become a better trader. And I was thinking out there today, I did that with technical analysis. Why don't we do that enough with psychology? So in today's episode, I want to talk a little bit about not just the psychological problems that you guys are having, because we all know that we have them, we all know what they are, but thinking about it from a different level and hopefully having that knowledge, that information, maybe that new perspective gives us another tool that we can use to problem solve these issues. So I recently heard a presentation by Jarrett Spencer. He does sports psychology, and this is something that we do with our athletes. And knowing that there's a kind of direct relationship between sports and trading and life, it's all the same, I thought it would be good for traders as well. And it talks about positive thinking. And I guess before we get too deep into positive thinking, it's important to understand how us as humans work, right? We know that we are motivated by two things, pain and pleasure. Pleasure is good stuff, pain is bad stuff. If there is one motivator that is stronger than the other, it is going to be pain. And before you beat yourself up for always being in kind of like a flight mode instead of a fight mode, understand that negative thinking, us being worried, concerned, putting pain on a pedestal, that's not something that you've necessarily decided to do. That is something that is ingrained in us from very early on. In fact, right, we wouldn't be here today if it wasn't. Think about the cavemen. We were in a much less protected time, right? Now we have the luxury, we can kind of go outside and do what we want. There's not that many natural threats aside from other human beings, but that's another story about how we're destroying ourselves. But back in the day when there were cavemen, you're out there in the wild with, tigers and lions and animals that are ready to kill you. So every waking moment of your life, you are on edge, right? You are kind of looking around trying to identify the threat. And that kind of way of thinking is ingrained in our neural pathways, and it's something that has stayed with us to this day. That is why it's so easy to be negative and a lot harder to be positive. I forgot the exact number, but I've always heard like it takes like 6 positive sayings to combat one negative saying, right? That's crazy, but we're so kind of tuned into giving power to the negative to negative to negative that we often forget a positive. Thinking about a trading example real quick. Think about how you feel when you win versus think about how you feel when you lose. When you win, it was supposed to happen. When you lose, it's the end of the world, and you panic. So hopefully what we're going to talk about today will help with that. So I want to start off by reading you kind of a statement by Jared. It goes like this. Everyone talks about the power of positive thinking. Positive thinking is universally accepted by all as an essential element of success. What is not commonly addressed are the symptoms of negative thinking, the opposite of positive thinking. It's important for each of us to understand or at least recognize our underlying problem areas in order to begin the process of change. Here are 15 patterns of negative thinking. Don't be surprised or concerned if one or more patterns fit like a glove to you specifically, right? We all experience these patterns at some point in time, but it is those 1 or 2 patterns when used excessively which negatively impact our daily lifestyle. And of course, I'll try to make it negatively impact our daily trading. So understand that these are going to be common. You're going to see this within you. It's not a negative if you're like, oh my gosh, that sounds like me. If you are a human or humanish, right, you are going to experience these. When I read through them, what I want you to focus on are which ones do I really harp on, which ones do I experience on a regular basis, because those are probably the first ones that you want to attack. So the first one is filtering, right? And filtering means that you take negative details and magnify them when filtering out the positive aspects of the situation. So you only look for the bad. So let's hop into a trading example. Let's say you were in a trade and you enter, the trade's going your way, and then it goes against you, and you exit early, you get out the trade. And then you come back to your screen, right? Days later, hours later, whatever it may be, and the trade went on to do exactly what you thought it would do, right? Early profit taking or stopping yourself out early. You probably beat yourself up. You probably say, oh man, Akil told me about taking targets early. Akil told me about stopping myself out early. Why didn't I stay in the trade? I would have won. My prediction was right. I'm a loser. You're beating yourself up. And yes, you should feel all the shame for making a mistake. You have to jot it down as a bad trade. Remember, good trades are classified as trades that we follow our rules 100%. Bad trades are trades where we break our rules. So yes, bad trade, shame on you. But as you do your review of the trade, make sure you take away the good aspects. Yes, you messed up on the trade management section of it, right? Boo, you stink. But the analysis was correct. The entry was correct. The stop loss was correct. The target was correct. Everything around the trade was correct except for the U part, the trade management part. So although you do want to, yes, poo-poo yourself for making a mistake, also take the positives as like, hey, I did good analysis. I analyzed a good trade. I did A, B, and C correctly because these are skills that will help you in the long run. All you have to do is fix that one mistake. Next is polarized thinking. This is thinking things are either black or white, good or bad, not seeing kind of the gray area and the both. This is very common in trading as traders, many of us think that we have to win every trade, meaning that, again, going back to good trade, bad trade, that a good trade is a winning trade, a bad trade is a losing trade. The fact of the matter is, we can be good traders, we can be very successful traders without winning that much. A trader can have a 40% win rate with a great risk reward and be a very profitable trader. They can be more profitable than someone that wins 99% of the time. And just because you don't win a lot, and we're kind of ingrained to in the society of winning more is better, doesn't mean you're bad. It's not as simple as my win rate is higher, this strategy is better, my win rate is lower, this strategy is worse. It takes all the pieces of the puzzle combined. So don't just judge yourself on one element. There are many ways to be successful. High win rate, okay risk reward, low win rate, really good risk reward, right? Plenty of ways to do it. So it's not just a black or white thing. I would just add to that as well. We touched on this in a few recent episodes of the Trading Coach podcast, What do we think of as success when it comes to traders? Well, many people think you have to be a full-time trader, you have to be a millionaire trader, you have to make six-figure returns every year to be a successful trader. Well, no, remember, success is different for everyone. Success may be making enough money to supplement your income and do some cool stuff, right? Use your trading income as your vacation money each year. Use it to maybe cut down the hours at your job. Use it to fund a college account for your kid, right? Success is not black or white. Success is not millionaire trader or bust. You could be very successful as a trader that makes an okay return, right? If you make 40% a year, that's amazing, right? That's more than you're going to make just investing in the stock market. You don't have to be 100% a year trader. So understanding that success and failure they mean different things to different people. It's not just one or the other. It's not binary. The next one is overgeneralization. That's a tricky word for me, so I had to say it slowly. But this means thinking that a single piece of evidence is true for everything. And we see this in so many different ways in trading, right? We spoke about recently patterns and how everything we trade in the market is a pattern. Every strategy is a pattern. It's something that is supposed to be testable, verifiable, and repeatable. With that being said, there are patterns that exist that aren't profitable. And sometimes as traders, because we want something to be profitable and we can see it with ease, we tell ourselves it's a profitable pattern and it's really not. So we don't want to overgeneralize something. A good example is this, right? Double tops mean reversals. No, this was a lesson that I personally learned in my trading where at one point in time when I may or may not have been in a rush to be a successful trader, I learned about the double top. It's a simple pattern formation. Price action goes up, finds resistance, retraces a little bit, goes up for a secondary touch, and then rallies off. Looks like this, or this. Nope, this. It looks this. I don't have enough fingers, but it looks like that. Two triangles, perhaps, right? It looks like an M. There we go. Why didn't I just say that in the beginning, Akil? Now I look like an idiot. It looks like an M, right? That's why the video version of these podcasts are awesome. You got to see me look like an idiot. That's why I haven't been doing as many of these as of late. It's an insult to my intelligence. Anyway, I thought double tops, right? Because I heard that, hey, they're good reversal patterns. Okay, I'm just going to trade every single double top. And I went into the market with live money because why test things out and make sure what you're doing is profitable when you can just trade it live and make money right away? Yeah, Thoughts of a New Trader. That sounds like a book title. Long story short, I lost a lot of money and I learned a lesson that double tops aren't too powerful in their own right. They are a very good tool. It is an entry technique that I use to this day. But what I like to say is the what, meaning the double top, is only as important as the where, meaning the location. So a double top in the middle of no man's land doesn't really mean a lot to me, but a double top at an important level of structure is a very exciting opportunity. But we don't want to generalize something and say like, oh, all double tops are great. All flag patterns break out to the upside. A lot of it depends on the overall situation. The problem is a lot of these trading gurus don't tell you that. They just show you the textbook examples in the video and move on. So the next one I'm going to touch on, and I'm skipping through some of these because they're not as trading relevant. This is another tough word for me, so bear with me. The word is catastrophe, but the word that I want to say is catastrophizing. I don't know if it's a word. It's written there, so blame Jarrett, not myself. But catastrophizing, ooh, look at that, nailed it, right, is expecting the worst, but without any evidence. So I'm a fan of preparing for the worst, right? Mentally, I like to think I'm more optimistic now, but I used to be very pessimistic, meaning I would always prepare for the worst because if the result was better for the worst than the worst, I would be excited. It brings me back to my school days where it's like I would take a test and I'd be like, man, I feel great about that test. I bet I got an A, and I'd come back and I'd get a D, and I'd be like, oh man. And I'd be all depressed because I got all excited about getting an A, and I had like bets with my mom and dad where if I got certain grades, they'd buy me stuff, and I'm like, I'm not going to get that PlayStation game, am I? So I kind of shifted my mindset, right, to kind of stop myself from feeling hurt as I sit on the couch and tell my therapist about my problems, to expect the worst or prepare for the worst. And that way, if it is better, I'm excited. So in trading, we always want to prepare for the worst. And a great way to do this is like risk management, right? Risk management is, or the risk size, I should say, is the amount of your account that you risk per trade, meaning that there should be a limit. So let's say your limit is 2%. That means no matter what happens in this trade, if it's a catastrophe, you will only lose 2%. So in that way, you're preparing for the worst, and the worst case scenario is 2%. The problem that people get into when we talk about catastrophizing is when it limits their action. So I was working with a trader the other day. He was going through the process. He had a trading plan. He had a strategy. We were talking back and forth every day, sharing our analysis. His analysis was very similar to mine, so we'd kind of check in on each other. So he'd send me emails and stuff like, hey, Akil, I'm on this chart. I see that. I'm looking for that. I just need that to enter. Let's go. And I'm like, yeah, I'm looking at the same thing, man. Let's go. Let's make this money, baby. Oh, sorry. Let's go. Let's make this money, baby. Right? That's the dance I'm supposed to do. It's a long joke here with the Trading Coach podcast. If you watch all the episodes, you know what I'm talking about. And then we'd analyze the trade. The trade would trigger. We'd make a lot of money, so I thought. And then I'd email him the next day and be like, yo, that euro yen went crazy. We got target 1s and target 2 smash, no pain trade. Made that money, baby, right? And he's like, yeah, I didn't do it. I'm like, what? He said, yeah, I'm sure. I said, what'd you say? I didn't take the trade, right? And I'm like, what do you mean you didn't take the trade? And he didn't take the trade because he freaked himself out. He thought of worst case scenarios and what if it does this? What if it does that? What if it's a black swan event? What if it's that? And I lose all my money. And all of that got so mumbled and jumbled and bumbled up that he was afraid to push the trigger and be involved. So we want to avoid that because although in our mind we are thinking that we are protecting ourselves from a bad situation, we're actually keeping ourselves out of a good situation or rather the situation that we're supposed to be in. So the next one is personalization. This is taking things personal. And typically what this means is that whenever someone says something or you hear something, even though it may not be about you, you're kind of self-conscious and you think it's about you. We see this a lot with trading forums. I have another example of this as well. But I always used to say trading forums are toxic, and I haven't been on a trading forum in a while. I have a trading community at Tier 1 Trading that you can join, a 14-day risk-free trial, right? But that's a little bit different. But trading forums used to be toxic because chat forums in general, well, you know how they are. Like someone wants to be the alpha male or the alpha female and boss everyone around and be like, I'm the best. And the strong people get stronger by intimidating and making the lower people, the new people, or the quiet people feel bad. And I remember I was on a trading forum once when I first started trading, and I was on there like a stalker, right? Someone, what voyeur is called, looking out the window, just peeking. I was in the forum, I read everything, but I never commented because I was scared and unconfident. And I remember after a long time, I finally had this trading idea, and I built up the confidence. I said, Akil, today's the day. You're going to type something in, and you're going to hit that enter button. I typed it in, and I spell checked it, and I made sure the chart was right, and I hovered around it, and I said, hey, and I took a break, and I came back, and I said, hey, and I took another break, and I came back, hey, boom, I hit the button, and my idea was on there. It was like, guys, I'm looking long euro dollar. Here's why. Here's the charts. Boom. And immediately right after that, and I don't know if it was in reply to me or it just happened to be a coincidence, but one of the gurus, the popular guy on the chart, Pipzilla, Scottie Pippen, whatever their name was like, yeah, guys, wouldn't look long euro dollar to save my life. Got to go for shorts. And I'm like, oh my gosh, he's talking about me. He's bashing me. And it was all about me. It may not have been about me. It could have been a completely another idea that just happened to be on euro dollar, which is the most popular pair. But for some reason, I thought it was a personal attack. Him saying he's smarter than me. I'm stupid. Anyone that follows me is stupid. And I lost all confidence. By the way, I didn't enter the trade. The trade ended up going long like I thought. And I didn't make any money off of it because I was catastrophizing and was scared to enter. But understand that because someone disagrees with your idea, doesn't mean it's a bad idea. The cool thing about trading is this, right? There are always, literally, right? Always buyers and sellers in the market. If there were not, the market would not move, right? So someone is always looking to get long. Someone is always looking to get short. If that did not happen, the market would tick sideways, right? That's exactly what would happen. And you could be a buyer. He could be a seller. She could be a buyer. She could be a seller. And both of you guys could be right. Because what's right or wrong isn't necessarily the result of the trade. It has more to do with your strategy. And in many cases, like for example, I'm a counter trend trader at heart. I could be looking at a chart and saying, hey guys, I'm looking for euro dollar short. John Doe can come in. Why did I say John Doe? Right? I chose the most basic name, right? Sam Smith came in, Stephen Smith, and says, hey, I'm looking long. Well, guess what? Price can go short and pull back to where Steve Smith is looking for his longs, then extend up, and we're both right. Right? You just never know. There's so many moving pieces between right and wrong. So it can't be a black or white thing. I feel like, what's that, polarized thinking, where it's wrong or right. Don't take it personal. The market is all about having differences of opinions. Your opinion is what matters most. Don't worry about what other people say unless it's some type of critique and feedback that helps you become a better trader. But just because someone has an idea that's different from you, and even me, right? Even when Jason and myself have different ideas than you guys on the platform, don't take it personally. It doesn't mean your idea is wrong. It just means that we may be seeing things from a different perspective or that we have different trading styles. The next one is going to be control fallacies. And this is where it feels like maybe you don't have control, kind of like you're feeling like you're helpless, you're the victim, one of those things. And this is the best example I can give with this is probably in the new trader stance where they feel like the markets are against them, where I can't win because my broker doesn't want me to win, which again, doesn't make any sense because when you trade, your broker gets paid. So why would your broker want you to blow all your money and not be able to trade when they get paid off you being traded? Doesn't make any sense. Secretly, your broker just wants you to trade forever, and it doesn't really care if you win or lose. It just wants you to trade, probably on a lower time frame, so you can execute more trades and they can get more profit from you. But brokers against me, the market's against me, the sun and the moon are against me, whatever it is. We create all of these excuses for why we can't be successful. Trading's gambling, and we can't be profitable in Forex, and the stock market's rigged, right? All of these are excuses. Do not fall victim for that. There is a way to win. Plenty have won before you. And if one person can win, that means multiple others can win. So shut up. That was harsh. The next one is called shoulds. I skipped a few others that were kind of really similar to like the fallacy of fairness, or one was control fallacy. The next one's fallacy of fairness, where life is unfair, blah, 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 blah. The next one is shoulds. And this is an interesting one because this is very common with traders where shoulds pretty much have like an ironclad set of rules where this is what should happen, this is how we should act. And when those rules aren't met, things go crazy, right? So it's pretty much people that can't, there's no gray area. It's black or white. And we see this a lot with traders because we teach a discretionary approach of trading. We have mechanical systems as well, but mainly if you're a price action trader, it's a discretionary approach. But it's also rules based. You've heard us talk about the IPDE process. You've heard us talk about the if-then syntax. We talk about trading plan and trading rules, right? You need to have a rule for how you're trading. And as far as analysis goes, we have rules for that as well. So for example, if we're talking about a level of structure, one of the rules that I have is that if price action breaks and closes above that level of structure, we call it a higher high, higher close, then its structure is violated, right? Previous structure resistance is violated. If previous structure resistance is violated, then I expect the market to go higher, right? So that is a rule that allows me to be as consistent as possible with my predictions. But what happens when price violates that level of structure and then goes down? Akil, the rule's broken. Oh my gosh, it shouldn't be. Panic. Explode, right? It sounds weird, but some people seriously go crazy over that because they're so stuck into this rule that they believe that it has to happen. And here's the thing about rules in the market. Well, here's the thing about the market in general, right? This is the one rule of the market. The market can do whatever the blanket wants whenever it wants to blank and do it, right? Blanks are the F word if you weren't familiar with that. I'm trying to keep this thing clean, but I want to be harsh with it. Understand it. The market will do whatever it wants, whenever it wants. It does not care about you. You are not important to the market. You are important to me because you're listening to the Trading Coach podcast, and I love my followers. But the market doesn't give a F about you, right? Put that in stone. So when we create these rules aren't for the market to follow. The market doesn't care, right? They aren't for the market to follow. There are rules for us to follow to put us in the best positions possible as consistently as possible. Meaning that maybe 8 times out of 10, if we get that higher high, higher close, that violation, price is going to go up. But there's still going to be 2 times that it goes down. Well, what that rule does is it puts us on the higher side of the probability, and that's what we're doing. Edges in trading are very, very slim, right? This is an edge in trading. Can you see this? Right? I can't see it. It's so slim. This is your edge in trading. It is paper thin, right? What we're trying to do is, oh no, I dropped the money. I don't care about the money I dropped. Money means nothing to me. I'm a super trader, right? That's not me pulling the money back with my foot. Nope, not at all. What that means for us is, as traders, we're just trying to bend the edge as much in our favor as possible. And it can be done through putting ourselves on the right side of the market as much as possible. It can be done through risk management tactics. It can be done with risk reward. But just because we have a rule doesn't mean it has to happen. But for the traders that are super literal, and we get a lot of these types, and there's nothing wrong. You guys are really good rule followers. Sometimes it could be a little bit confusing when you expect something to happen and it doesn't happen. This goes back to the conversation we always have about how super smart individuals often struggle at trading, right? I didn't struggle that much at trading because me dumb. So in my life, I spent a lot of time being wrong, understanding how to be wrong, and problem solving for being wrong, right? For you guys that are super smart out there, you're not used to being wrong. So you're used to being right. You're used to always getting the right answer. And when you do everything right that is supposed to get you the right answer and you don't get the right answer, you don't know how to deal with it. Haha, take that, all you nerds that made me feel bad in high school. Not bitter, again, therapist session is you guys. But that's the truth. Super smart people find it hard because it just doesn't make sense, right? If you do things a certain way, it should be right. And those just aren't the rules the market follows. So suck it up, buttercup. The next one is a little bit of a follow-up on this. This is actually going to be a really good one. What was the Dr. Brett Steenbarger, what was the name of his daughter? The Darren principle? Give me a second. The Devon principle, I actually guessed it before I even found it. You got to believe me on that. The Devon principle, where, remember, kind of like, was it self-fulfilling prophecy? Like, in the Devon principle, you talked about you're more excited and willing to do better work on the things that you care about. The next one here is called emotional reasoning, and that is kind of like what you believe to be true becomes true. So if you call yourself like, I'm bad at math, that was a Devon example. If I'm bad at math, I can't be good at math, you're probably going to be bad at math. If you're excited and good about science, you're probably going to be good about science. We see this in trading a lot where it's like, well, I'm not smart enough to be a trader, although I told you that super smart people struggle. I'm not smart enough to be a trader, so I can't be a trader. I didn't go to an Ivy League school or learn economics in college, therefore I can't be a trader. This is something I dealt with a lot in my career, and this is why many of you guys said the Trading Coach podcast has been so helpful, because this is one of the first times that you've seen someone like me, right, over the last 18 years, who didn't come from a traditional background, really no background. I just kind of got into the stock market and started figuring it out myself. But you saw that I'm able to be successful, and it's given you hope and belief that you could be successful too. And I really value that. It's one of the reasons I love doing all this stuff for you guys. But very early on in my trading career, I looked at what Wall Street looked like, what successful traders looked like on the internet, and none of them looked like me, right? They all looked like they went to proper educational places, worked for prop firms, they were suit and tied up, they weren't in a blue t-shirt, my fancy one, right? Another inside joke. And I didn't believe that I can be successful, because if that's what success looked like, and I looked like this, there's a little bit of a difference there. So I started believing that I was bad, and because I believed I was bad, and this is when I went to the whole Tony Robbins thing of like, affirmations and rewiring my neural pathways to believe that I was good and say that I can be successful, I deserve success, and kind of rewiring it that way. So being stuck in your thoughts negatively will push you in a negative direction. However, being stuck in your thoughts positively can push you in a positive direction. Go that way. 2 more left. The penultimate is being right. Well, no, the penultimate isn't being right. The penultimate number is being right. The being right. The thing is being right. You get what I'm saying, right? So This being right is kind of, you're on this consistent mission, I guess you can say, to prove that your actions and your opinions are correct. You're not really worrying about being successful, you're worrying about being right. And right and successful aren't necessarily the same thing. Again, imagine this as a trader. We talked about how you can be a successful trader as a 40% trader, where you win 4 out of every 10 trades, you win 4, you lose 6, right? That's not necessarily the same as being right, because percentage-wise, you're actually more wrong than you are right. And a lot of traders get in trouble in the market because they value being right, ego, over profitability. You guys have heard the story about the 90% trader, a trader that I worked with whose whole goal was to be like 90% win rate. And I told him, hey, you shouldn't worry about that. You should worry about your return on investment. You don't have to be 90%, blah, 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 but didn't want to hear it. Didn't end up working with him for too long, but months later, he emailed me back saying, Akil, I did it 90% correct. I said, yeah, what was that return on investment like? He said, I lost money. I said, what? Right? How did you lose money? And it was a whole thing. He was, he was taking targets really, really early. Losses were full. Risk reward was like, if this is risk, this was reward. So you know how it goes. But the fact was, he valued being right. Like, he didn't care that he didn't make money. It was weird to me because I'm all about making money. But he was like, I did it. I won 90% of my trades. And I'm like, okay, well, congrats. But like, you didn't really achieve anything. But for him, it was more about proving he can outsmart the market instead of proving that he can make money, which lends to be the question, like, did he actually outsmart the market? Because he won, but he really lost. So like, did he win? Or did the market just make him feel like he won when, I don't know. It's a whole thing. But that's what kind of, you value rightness more than profitability. You see this on the internet a lot, where everyone's kind of bragging about how much money they made, or even people changing their trades to kind of beat someone else just to prove their opinion right, or staying in trades. That's another one as well. People get married to their trades, where I've seen so many traders that have entered a trade, let's say for legit reasons, and then the market has given them clues that this isn't going to work. And rule number 17B of trading is that when the market shows you that you're most likely wrong, you should probably get out of the trade, right? That is your signal to get out with as little loss as possible, move on to the next one, right? But you'll see traders who will be in a trade, the market will tell them that they're wrong. It will knock on their door and be like, hey, message for Johnny, you're wrong. But because they're married to their idea, they're not worried about the actual trading result. They're more worried about, well, I posted this on social media and I don't want to look like an idiot for being wrong. I'm going to stay in this trade. And they end up taking a much bigger loss than they should have. Traders like that are more concerned about being right than profit. Whatever. Lastly is the reward fallacy. And the reward fallacy means that you expect to be rewarded off of everything you do. We see this a lot with the instant gratification kind of era that we're in, where it's like, I worked hard, therefore I should be rewarded. So a good example is like in real life would be like a diet, where like you go to the gym, you have this really killer workout, and you go home to the scale and you're like, I weigh the same as I did. And it's like, well, one workout's not going to change anything with you. It's about consistency, but people want that instant reaction, and they're like, I did a workout at the gym, didn't work. I'm just going to take this pill and shortcut it. And then they kill their body and their brain and all that fun stuff. We see this in trading too, where people want to be right away. They don't understand the grind. This is where we talk about the power of compounding, where I say, like, your first 5 years of trading are probably going to be minimally profitable as far as like a monetary figure goes, right? Meaning that your account's going to be here and you're just going to be like, okay, I made a little bit, I made a little bit, I made a little bit, made a little bit, made a little bit. But there's going to be a point in time, if you're consistent with that, you get to a level where it's just going to jump, right? It's going to jump up, and you're going to be really, 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 really profitable. But it takes those years of kind of building the fire. I don't know how to build fire. You do it, and then you blow on it, and you rub it together, and you build the fire for 5 years, right? I'm building it, and then boom, the fire takes off, and now it's ablaze. And we probably should be talking about fires. There's lots of disasters in LA still going on. I didn't mean it to go there, but just on my mind. I got family in LA, so it's hitting close to home. But anyway, people give up on trading because they don't see the initial benefit. They trade for a year, if they make it to a year, they trade for 2 years and they're like, man, I'm not a millionaire yet. I'm just gonna go find the next thing. And the truth is that your reward, hard work does pay off. I'm a firm believer in that. But it doesn't pay off right away, right? You have to put in work consistently, and in the long run, it will pay off. And I'll leave you on this note. This is one of the biggest lessons that I've learned in my career, and I gotta figure out how many years I've been trading now. But it took me about 2 full years of hell and struggle. And those were the 2 longest, hurtful, most painful years of my life where I wanted to quit, not every day, but very, very close to every other day. And it was hard for many reasons. Trading was hard. The support wasn't there, which was hard. Everyone was telling me to quit, and I was stupid. It was just hard. I didn't have a community to kind of fall back on either. So I was kind of floating out by myself in space like Sandra Bullock, right? Great movie, by the way. And I look back at it now, and what I've been going 18 years. So the 2 massively painful years were hell at the time. But now I have 16 years of good trading, 16 years of profitable trading. And that 16 years engulfs that 2 years. So it seems like nothing. But that's because I'm talking to you now, 18 years later. At the time, it was hell. So you have to trust me on this. For you guys that are in that section right now where you're going through the funk and it stinks right now, you have to believe that there's a light at the end of the tunnel if you keep grinding. You're not going to see the results yet, but one day you're going to be able to look back and be like, man, those 2 years of sacrifice that I thought were hell, nothing at all. Well worth it. Hope you guys enjoyed the podcast. Again, probably one of the longest episodes I did, but I was really excited about this subject. Again, so excited that I have to go back and finish shoveling, but I wanted to get it to you because I think you guys need to hear it, and I think you deserve to hear it. So leave me a rating, leave me a review before you go if you haven't done so already. That's the best way to support the show. And until next time, plan your trade, trade your plan. Take care.